So the month of October has arrived, and after just 2 days, the Dow is down roughly 800 points. Short-term traders love this kind of volatility. But what about long-term investors? What should they do with this? Joining us now with her thoughts, Jenny Harrington is the CEO and portfolio manager of Gilman Hill Asset Management. Jenny, good to see you tonight.
Thanks for having me, Bill. Hi, Sue.
You're a long-term investor. What do you make of this volatility this month so far?
I don't make anything of it. To me, it's just a blip. Since over the past 10 years, we've had something like 65 different versions of panic attacks where the markets moved up, down, and scared the daylights out of people. And I don't think right now that this is anything different. I don't think it's the beginning of something nefarious.
So as a long-term investor, Jenny, do you just ignore all the headline risk that's out there, or do you take a look at maybe opportunity?
I think you're always looking for opportunity. And I have this goofy bumper sticker in my office that says, I love volatility, because volatility creates opportunity. But I think you always stand back, look at your portfolio and say, has it done what I intended it to do? Was it set up strategically for what I need it for? 2 years ago, 5 years ago, 10 years ago, is it doing that? And is it positioned to do that going forward? If it's not, then maybe you want to make changes, but don't make changes just because we're down 5% over the last 5 days. Make changes because it's always a good time to think thoughtfully and maybe make a change.
But here's what I always think about. When does long-term investment thinking become complacency? You're down 5%, maybe you go down 10% and you say, well, I'm a long-term investor, I'm going to ride this thing out.
I think you can always ride it out, right? And you can take a step back and say, over the past 10 years, we've had the market down 18% or so in 2013 and 16% in 11. I might be off a little on that. But we've ridden through all of those. And the annualized return over the past 10 years is 13.5%. So if you can ride those out, if you can ride the down 18% and down 16% out, you know what you get in the end? You get an annualized return of 13.5%, which is really solid. And I'm going to say that I don't have a crystal ball, so I would never know exactly when to get in and when to get out. So I'd rather ride those out and be just very thoughtful and very diligent and know that I'm positioned for anything that comes my way.
So given that, as you manage money for clients and look at the market, is the economic data a little bit more important overall than the day-to-day activities in the market?
The economic data is definitely more important than the day-to-day, for sure. And then more important than that, even as each company that we're invested in, is what's at the corporate level and what's happening at the corporate level there. And will that company be able to ride out whatever storm comes your way?
Having said that, what do you like right now?
Good question. Okay, so that's loaded for me, right? I always like dividend stocks because I'm a dividend investor. I like dividend stocks, but that's not, I'm a little joking. I like stocks with really high free cash flow yields. And some of those stocks are going to choose to pay it back in a dividend, and some are going to buy back shares or improve their businesses. But I love things with that high free cash flow yield. And we actually manage two portfolios. One is a dividend stock portfolio and one is a disciplined growth portfolio. But the hurdle is a high free cash flow yield. Because if the company's pumping out high free cash flow, they can actually skate through a 2008, 2009. And I don't mean the share price skates through, but the business skates through.
Very good. Jenny Harrington with Gilman Hill Asset Management. Good to see you again.
Thanks for having me.
You bet.